The properties associated with Bitcoin make it an ideal store of value. The supply is finite. It is easily portable, divisible, durable, fungible, censorship-resistant, and non-custodial. Bitcoin is rarer, more liquid, easier to move, and harder to confiscate. It can be sent anywhere in the world at almost no cost and at the speed of light. Yo, 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 and welcome back to another episode of the Nyc and Griff Show. Today is Thursday, August 8th, 2024. It's 4:54 p.m. Hope you guys are having a great week. Coming to you with some thoughts, a little bit of an article read today. We just had the Bitcoin Conference 2024, last couple of weeks, whenever it was. So all of those interviews, all of those talks are coming out. I listened to Michael Saylor's, as did, I'm sure, a lot of you. All he talked about was wealth preservation. What an interesting topic. How do we store the economic value that we're expending time and labor in the market in exchange for? How do we store that? I want to open up with a thought here from Kamala Harris. She's got some gaslighting for you. Let's listen to what she's got to say.
Because while our economy is doing well by many measures, prices for everyday things like groceries are still too high. You know it and I know it. When I was Attorney General, I went after price-fixing schemes. And when I am president, it will be a day one priority to fight to bring down prices. I will take on big corporations that engage in illegal price gouging. I will take on corporate landlords that unfairly raise rents on working families. I will take on big pharma and cap the cost of prescription drugs for all Americans and continue to bring manufacturing jobs back to America.
So let's just talk about the gaslighting just for a half a second. So we know that inflation's primary cause is the expansion of the monetary base, which is just to say, there's a total amount of dollars that's in the market. And when more dollars are added to the market and that supply grows, each individual dollar represents less and less of the entire stock of existing dollars, right? When that happens, it shows itself in this inflation that we all talk about. Inflation can happen in multiple ways. There are real market stimulants that fluctuate prices up and down. But what we've seen over the last handful of years is not that. It is the expansion of the monetary base. And, you see all kinds of gaslighting, just like the clip that we just watched there. It's all over the place. Go read an article. Go listen to a newscast. I mean, it's incredible to see the gaslighting that we're seeing here. And so in light of some of these thoughts, I have done some reading and have been interested in the ideas of wealth preservation. What are people doing and talking about in terms of this with respect to Bitcoin? And found an incredible article. And I thought, man, the people have got to hear this. They got to see it. They got to hear it. Want to make it easy for you guys to access some of this info. So without further ado, here is why Bitcoin is the ultimate wealth preservation technology. It's written by Leon Wankum in November of 2022, so a couple of years ago. Subtitle is Bitcoin is the best store of value when compared to other asset classes that have historically been used by people wanting to protect their wealth. Let's jump into it. The following article is the last part of a series of articles in which I aim to explain some of the benefits of using Bitcoin as a tool. The possibilities are endless. I selected 3 areas where Bitcoin has helped me. Bitcoin helped me take my entrepreneurial endeavors to the next level by allowing me to easily and efficiently manage my money and build savings. In part 1, I explained what opportunities Bitcoin offers for real estate investors. In part 2, I described how Bitcoin can help us find optimism for a brighter future. Evolutionary psychologists believe that the ability to preserve wealth gave modern humans the decisive edge in evolutionary competition with other humans. Nick included an interesting anecdote in his essay Shelling Out: The Origins of Money. When Homo sapiens sapiens displaced Homo neanderthalis, I don't know how to pronounce these words, sorry, in Europe roughly 35,000 years ago, a population explosion followed. It's difficult to explain why, because the newcomers, Homo sapiens sapiens, had similar sized brains, weaker bones, and smaller muscles than the Neanderthals. The biggest difference may have been wealth transfers made more effective or even possible by collectibles. Homo sapiens sapiens took pleasure from collecting shells, making jewelry out of them, showing them off, and trading them. Neanderthals did not. It follows that the capability to preserve wealth is one of the foundations of human civilization. Historically, there have been a variety of wealth preservation technologies that have constantly changed and adapted to the technological possibilities of the time. All wealth preservation technologies serve a specific function: to store value. Chief among the early forms is handmade jewelry. Below, I will compare Bitcoin to the four most commonly used wealth preservation technologies today: gold, bonds, real estate, and equities, to show why they underperform and how efficiently Bitcoin can help us save and plan for our future. For equities, I focused specifically on ETFs as equity instruments used as a means of long-term savings. What makes a good store of value? As explained by VJ, when stores of value compete against each other, it is the unique attributes that make a good store of value that allows one to outcompete another. The properties of a good store of value are durability, portability, fungibility, divisibility, and especially scarcity. These properties determine what is used as a store of value. For example, jewelry may be scarce, but it's easily destroyed, not divisible, and certainly not fungible. Gold fulfills these properties much better. Over time, gold has replaced jewelry as humankind's preferred technology for wealth preservation, serving as the most effective store of value for 5,000 years. However, since the introduction of Bitcoin in 2009, gold has faced digital disruption. Digitization optimizes almost all value storing functions. Bitcoin serves not only as a store of value, but is also an inherently digital money, ultimately defeating gold in the digital age. Bitcoin versus gold. Durability. According to VJ from earlier that he's mentioning, gold is the undisputed king of durability. Most of the gold that has been mined remains extant today. Bitcoin is a ledger of digital records. Thus, it is not Bitcoin's physical manifestation whose durability should be considered, but the durability of the institution that issues them. Bitcoin, having no issuing authority, may be considered durable so long as the network that secures it remains intact. It is too early to draw conclusions about its durability. However, there are signs that, despite instances of nation-states attempting to regulate Bitcoin and years of attacks, the network has continued to function, displaying a remarkable degree of anti-fragility. In fact, with nearly 99.99% uptime, it is one of the most reliable computer networks ever. Portability. Bitcoin's portability is far superior to that of gold, as information can move at the speed of light, thanks to telecommunication. Gold has lost its appeal in the digital age. You can't send gold over the internet. Online gold portability simply doesn't exist. For decades, the inability to digitize gold created problems in our monetary system. With the digitization of money, whether national currencies were actually backed by gold was not clear. Additionally, it is difficult to transport gold across borders because of its weight. This has created problems for globalized trade. Our fiat-based monetary system exists today because of gold's weakness in terms of portability. Bitcoin is a solution to this problem, as it is a natively digital, scarce commodity that is easily transportable. Divisibility. Bitcoin is purely digital, so its divisibility is much better than gold. Information can be subdivided and recombined almost infinitely at almost zero cost. A Bitcoin can be divided into 100 million units, called satoshis or sats. Gold, on the other hand, is difficult to divide. It requires special tools and carries the risk of losing gold in the process. Fungibility. Gold can be distinguished in many ways, i.e., with an engraved logo, but when it's melted down, it becomes fully fungible. With Bitcoin, fungibility is tricky. Bitcoin is digital information, which is the most objectively discernible substance in the universe. However, since all Bitcoin transactions are transparent, governments could ban the use of Bitcoin that has been used for activities deemed illegal. This would negatively impact Bitcoin's fungibility and its use as a medium of exchange, because when money is not fungible, each unit of money has a different value, and the money has lost its medium of exchange property. This does not affect Bitcoin's store value function, but rather its acceptance as money, which can negatively impact its price, which I would say probably further impacts its use as a store value. Gold's fungibility is superior to Bitcoin's, but gold's portability disadvantages make it useless as a medium of exchange or a digital store of value. Scarcity. Gold is relatively scarce with an annual inflation rate of 1.5%. However, the supply is not capped. There is always new discoveries of gold, and there is a possibility that we will come across large deposits in space. Gold's price is not perfectly inelastic. When gold prices rise, there is an incentive to mine gold more intensively, which can increase supply. In addition, physical gold can be diluted with less precious metals, which is difficult to verify. Furthermore, gold held in online accounts via exchange-traded commodities or other financial products is difficult to control and negatively impacts the price by artificially increasing supply. On the other hand, the supply of Bitcoin is hard capped. There will never be more than 21 million. It is designed to be deflationary, meaning there will be less of it over time. Bitcoin's annual inflation rate is currently 1.75% and will continue to decrease. Side note, as of now, this was written 2 years ago. As of now, I believe Bitcoin's inflation rate is less than 0.8%. So verify that for me, but it is actually a lot lower now. The inflation rate is also technically less than gold. So that's pretty cool. Bitcoin mining rewards are halved roughly every 4 years in accordance with the protocol's code. In 10 years, Bitcoin's inflation rate will be negligible. The last Bitcoin will be mined in the year 2140. After that, the annual inflation rate of Bitcoin will be 0. Auditability. This is not a unique proposition for a store of value, but it is still important because it provides information about whether a store of value is suitable for a fair and transparent financial system. Bitcoin is perfectly auditable to the smallest unit. No one knows how much gold exists in the world, and no one knows how many US dollars exist in the world. As pointed out by Sam Abbasi, Bitcoin is the first perfectly public, globally auditable asset. This prevents rehypothecation risk, a practice whereby banks and brokers use assets posted as collateral by their clients for their own purposes. This takes an enormous amount of risk out of the financial system. It allows for proof of reserves, where a financial institution must provide their Bitcoin address or transaction history in order to show their reserves. Here's an image of a quote from Bill Miller. It says, Bitcoin is like the printing press, steam machine, railroad, automobile, or electricity, a well understood path for the adoption of new tech. That's an interesting quote. Bitcoin versus bonds. In 1949, Benjamin Graham, a British-born American economist, professor, and investor, published The Intelligent Investor, which is considered one of the foundational books of value investing and a financial literature classic. One of his tenets is that a balanced portfolio should consist of 60% stocks and 40% bonds, as he believed bonds would protect investors from significant risk in the stock markets. While much of what Graham described still makes sense today, I argue that bonds, particularly government bonds, have lost their place as a hedge in a portfolio. Bond yields cannot keep up with monetary inflation, and our monetary system is systematically at risk. This is because the financial health of many governments that form the heart of our monetary and financial system are also at risk. When government balance sheets were in decent shape, the implied risk of default by a government was almost zero because of two main reasons. First, their ability to tax, and second, and more importantly, their ability to print money to pay down debt. In the past, that bond allocation made sense, but eventually printing money has become a credit boogeyman, as explained by Greg Foss. Governments are circulating more money than ever before. Data from the Federal Reserve shows that a broad measure of the stock of dollars, known as M2 or M2 money supply, rose from $15.4 trillion at the start of 2020 to $21.18 trillion by the end of December 2021. The increase of $5.78 trillion equates to 37.53% of the total supply of dollars. This means that the dollar's monetary inflation rate has averaged well over 10% per year over the last 3 years. Treasury bonds are yielding less. If you're not watching, we do have video on Spotify and on YouTube, so come watch. But there's a chart here of the M2 money supply going up and to the right, as you can imagine. The return that one could earn on money tomorrow by parting with that money today should theoretically be positive in order to compensate for risk and opportunity cost. However, when inflation is accounted for, bonds have become a contractual obligation to lose money. In addition, there is the risk of a systematic failure. The global financial system is irreversibly broken, and bonds are at a high risk. There is an irresponsible amount of credit in the markets. In recent decades, central banks have had very loose debt policies, and nation states have incurred large amounts of debt. Argentina and Venezuela have already defaulted. There is a possibility that more countries will default on their debt. This default does not mean they can't pay back their debt by printing more money. However, this would devalue the national currency, causing inflation and making most bonds ever less attractive with their comparatively low yields. In the past 50 years, when equities sold off, investors fled to the safety of bonds, which would appreciate in risk-off environments. This dynamic built the foundation of the infamous 60-40 portfolio, as referenced earlier, until that reality finally collapsed in March 2020 when central banks decided to flood the market with money. The attempt to stabilize bonds will only lead to an increased demand for Bitcoin over time. Graham's philosophy was to preserve capital first and foremost, and then to try to make it grow. With Bitcoin, it is possible to store wealth in a self-sovereign way with absolutely zero counterparty or credit risk. Really interesting thoughts there on Bitcoin versus bonds. Bitcoin versus real estate. Given the high levels of monetary inflation in recent decades, keeping money in a savings account is not enough to preserve the value of that money. As a result, many people hold a significant portion of their wealth in real estate, which has become one of the preferred stores of value. In this capacity, Bitcoin competes with real estate. The properties associated with Bitcoin make it an ideal store of value. The supply is finite. It is easily portable, divisible, durable, fungible, censorship-resistant, and non-custodial. Bitcoin is rarer, more liquid, easier to move, and harder to confiscate. It can be sent anywhere in the world at almost no cost and at the speed of light. On the other hand, real estate is easy to confiscate and very difficult to liquidate in times of crisis, as recently illustrated in Ukraine, where many turn to Bitcoin to protect their wealth, accept transfers and donations, and meet their daily needs. In a recent interview, Michael Saylor detailed the downsides of real estate as a store value asset. As explained by Saylor, real estate in general needs a lot of attention when it comes to maintenance. Rent, repairs, property management, and other high costs may arise. Commercial real estate is very capital intensive and therefore uninteresting to most people. Furthermore, attempts to make the asset more accessible have also failed, with second-tier investments such as real estate investment trusts or REITs falling short of actually holding the asset. As Bitcoin, digital property, continues its adoption cycle, it may replace physical property as the preferred store of value. As a result, the value of physical property may collapse to its utility value and no longer carry the monetary premium of being used as a store of value. Going forward, Bitcoin's returns will be many times greater than real estate, as Bitcoin is just at the beginning of its adoption cycle. In addition, we will most likely not see the same type of returns on real estate investments as we have in the past. Since 1971, house prices have increased nearly 70 times. Beyond that, Dylan LeClaire points out in his article, The Conclusion of the Long-Term Debt Cycle and the Rise of Bitcoin, governments tend to tax citizens at times like this. Real estate is easily taxed and difficult to move outside of one jurisdiction. Bitcoin cannot be arbitrarily taxed. It is seizure resistant and censorship resistant outside of the domain of any one jurisdiction. Here's a quote, another photo quote from Ray Dalio. It says, "I own some. Bitcoin is one hell of an invention. Bitcoin has made a tremendous achievement over the last 11 years." Cool quote. Bitcoin versus ETFs, or equities. Exchange-traded funds emerged from index investing, which utilizes a passive investment strategy that requires a manager to only ensure that the fund's holdings match those of a benchmark index. In 1976, Jack Bogle, founder of the Vanguard Group, launched the first index fund, the Vanguard 500, which tracks the returns of the S&P 500. Today, ETFs manage well over $10 trillion. Bogle had a single tenet: active stock picking is a pointless exercise. I recall him stating in his interviews that over a lifespan, there is only a 3% chance that a fund manager can consistently outperform the market. He concluded that average investors would find it difficult or impossible to beat the market, which led him to prioritize ways to reduce expenses associated with investing and offer effective products that enable investors to participate in economic growth and save. Index funds require fewer trades to maintain their portfolios than funds with more active management schemes and therefore tend to produce more tax-efficient returns. The concept of an ETF is good, but Bitcoin is better. You can cover a lot of ground through an ETF, but you still have to limit yourself to one index, industry, or region. However, when you buy Bitcoin, you buy a human productivity index. Bitcoin is like an ETF on steroids. Let me explain. The promise of Bitcoin should at least be on everyone's minds by now. Bitcoin is a decentralized computer network with its own cryptocurrency, Bitcoin with a lowercase b. As a peer-to-peer network, this enables the exchange and, above all, the storing of value. It is the best money we have and is the base protocol for the Lightning Network, the most efficient transaction network there is. It's very likely that Bitcoin will become the dominant network for transactions in the not-too-distant future. At that point, it will act as an index of global productivity. The more productive we are, the more value we create. The more transactions are executed, the more value needs to be stored. The higher the demand for Bitcoin, the higher the price of Bitcoin. I've come to the conclusion that instead of using an ETF to track specific indices, I can use Bitcoin to participate in the productivity of all humanity. As you might expect, Bitcoin's returns have outperformed all ETFs since its inception. The Spider S&P 500 ETF Trust is the largest and oldest ETF in the world. It is designed to track the S&P 500 stock market index. The performance over the last decade was 168%, which translates to an average annual return of 16.68%. Not bad, especially given that all an investor had to do was hold. However, over the same period, Bitcoin's performance was, get this, 158,382.362%, more than 200% per year. We've all heard the phrase that past performance is no indicator of future results. That may be true, but that is not the case with Bitcoin. The higher a stock goes, the riskier it becomes because of the P to E ratio. Not Bitcoin. When Bitcoin increases in price, it becomes less risky to allocate to because of liquidity, size, and global dominance. The Bitcoin network has now reached a size where it will last due to the Lindy effect. We can therefore conclude that Bitcoin is likely to continue to outperform ETFs going forward. Bitcoin has other advantages over an ETF. First, it has a lower cost structure. Second, ETFs are a basket of securities held by a third party. You are not free to dispose of your ETF. If, for whatever reason, your bank decides to close your account, your ETFs are gone too. But Bitcoin cannot be taken away from you so easily. Additionally, Bitcoin can be moved across the internet at will at the speed of light, making confiscation nearly impossible. Conclusion: Bitcoin is the best wealth preservation technology for the digital age. It is an absolutely scarce, digitally native bearer asset with no counterparty risk. It cannot be inflated and is easily transportable. A digital store of value, transferable on the world's most powerful computer network. Considering that the Bitcoin network could theoretically store all of the world's $530 trillion of wealth, it may well be the most efficient way we humans have ever found to store value. By holding Bitcoin, your wealth is going to be protected and likely increased during this early monetization process, if you hold out for the next few decades. In closing, I'd like to revisit Jack Bogle, who had a huge influence on me. As described by Eric Balchunas, Bogle's work is addition by subtraction, getting rid of the management fees, getting rid of the turnover, getting rid of the brokers, getting rid of the human emotion and the bias. I think Bitcoin fits well with his investment ethos. Bogle's primary philosophy was common sense investing. In 2012, he told Reuters, "Most of all, you have to be disciplined and you have to save, even if you hate our current financial system. Because if you don't save, then you are guaranteed to end up with nothing." Bitcoin is very similar to what Bogle envisioned with passive mutual funds, a long-term savings vehicle for investors to place their disposable income with low cost and low risk. Don't be distracted by Bitcoin's volatility or negative press. Jack Bogle says, stay the course. We're just getting started. Stay humble and stack sats. Your future self will thank you. Guys, what a great article. Go read it yourself. The link will be down below. There is a difference, in my opinion, between investing and savings. And when we are trying to save the capital that we've earned, we're trying to save. That means that we don't want to take risk. That means that I'm not trying to go buy some stock in some company, or I'm not trying to go buy a real estate property. I'm just trying to save what I have. I don't want to have to go buy something else that's going to incur additional maintenance fees to continue holding that store of value. We know that equities, right, require a management fee depending on what you're kind of investing in, right? We know that real estate is obviously very maintenance intensive in terms of, it's funny, most people in real estate, it's like, oh, it just always goes up. It goes up over time. And maybe that's what it has been in the past. And I think as the printer continues to go burr, as we know it is, that will probably continue to happen to some degree. But think about this, right? You build a physical structure, it actually does deteriorate over time. Interesting thought, right? Okay, so the maintenance cost there for real estate, and then talks about basically gold being dilutive over time. I'm reading another article right now and may do an article read on it. Lynn Alden's new article, I forget what it's titled, but she just posted a new article about corporate treasury strategies and basically this question of, am I being diluted? Is my capital being diluted? And if so, at what pace? That's kind of where that's the question she opens up her article with. It's such an interesting topic to think about, wealth preservation, what tools we can use to best do that. And you know that our answer here on the Nyc and Griff Show is Bitcoin every single time. I hope you guys enjoyed the article here. If you've got thoughts, comments, let us know at Twitter. It's at Nyc and Griff Show on Twitter. It's all spelled out. NYCANDGRIFFSHOW. Come check us out there. Also, if you go to nycandgriffshow.com, you will have it'll generate the link tree, and you'll see all of our links in there for all of our platforms. If you're not watching, we do have video on Spotify and on YouTube, so follow along with us there. But hey, we've got a great episode. We've got a great guest coming on here this weekend. Actually, really excited about it. We're going to break down a new article that they just wrote. So stay tuned for that, and we'll see you next time. Peace.